Welcome back to the Deep Dive, everyone, and a special welcome if you're joining us today from the Stock Explorers podcast.
Great to have you with us.
Today we are taking a deep dive into a company that's making a lot of waves, maybe for different reasons, in the tech sector. Wolfspeed, ticker symbol WOLLF.
Yeah, definitely a name that comes up a lot lately.
Right. And our aim today is really to, cut through some of the hype and maybe some of the fear and give you a clear picture of what makes their technology important.
And crucially, the financial risks, because they are significant.
Very significant. We've done the homework, looked at the numbers, the reports, to try and pull out what really matters for you to understand.
Okay, so Wolfspeed. The key thing to grasp is their focus on silicon carbide, SiC.
CSC, right. Why is this material getting so much attention? Why potentially replace good old silicon?
Well, fundamentally, it just performs better in power electronics. Think high voltage, high power stuff.
Okay, better how? The sources mentioned efficiency first, like 21% lower on resistance and 15% lower switching losses. But what does that actually do?
Okay, think of on resistance like electrical friction. Lower friction means less energy wasted as heat when the electricity flows.
Less wasted heat. Good.
Very good. In an EV, for instance, that could directly mean, more miles per charge because the battery's power is actually moving the car, not just heating up the electronics.
Oh, right. That makes sense. More range is always the goal there.
Exactly. Or think about these massive AI data centers. They consume enormous amounts of power.
Huge amounts.
If SiC components make them even just a bit more efficient, the overall energy savings could be staggering. Plus, less heat means lower cooling costs, which are also a massive expense for data centers.
Okay, so it's efficiency and potentially lower operating costs. What about the faster switching? That came up too.
Yeah, SiC can switch on and off much, much faster than silicon. It's down to the material physics, the wider band gap energy.
And the benefit of switching faster is?
Smaller components. You can design smaller, lighter power conversion systems. So imagine your solar inverter on your house or the converters in wind turbines.
Right.
If they're smaller and lighter using CC, they're easier to install, maybe cheaper to ship, could even open up new places to put them. Same goes for industrial motor drives, potentially lowering system development time and cost.
So efficiency, smaller size, and the sources also stress durability. Tougher than silicon.
Definitely tougher. Silicon carbide is inherently more robust. It handles things like cosmic radiation better, which sounds niche, but matters for long-term reliability.
Okay.
And it can withstand short circuits for longer. The figure was, up to 2.3 microseconds? That added resilience means CSI devices should last longer and fail less often, especially in demanding jobs.
So we're talking potential for longer range EVs, data centers that use less power, smaller renewable energy systems.
Yeah.
It really does sound like game-changing tech.
The potential is certainly there across quite a few industries.
And Wolfspeed's big push seems to be towards these larger 200-millimeter silicon carbide wafers.
Yeah.
Why is that specific size so important?
It's all about manufacturing economics, economies of scale.
Okay.
Think of it like baking cookies. You can make more cookies faster and cheaper per cookie on a bigger baking sheet. Making chips on a larger 200-millimeter wafer compared to the older 150-millimeter ones means you get more chips per wafer.
More chips, lower cost per chip. Makes sense.
Exactly. If they can get the manufacturing yields right, and that's a big if, it's a complex process. It brings the cost of silicon down, making it more competitive against standard silicon for more applications.
And they've poured a lot of money into building the factories for this, right? Like the Mohawk Valley plant.
Yes, huge investments. The Mohawk Valley Fab in New York is a big deal. Supposedly the world's first fully automated 200-millimeter assay device fab. Automation is key for consistency and cost.
And then there's the Plant JP facility.
In Siler City, North Carolina, that's planned to be the world's largest 200-millimeter SiC materials facility, so making the raw wafers themselves.
The vertical integration, controlling the whole process from material to finished chip.
That's the strategy. It could give them a big advantage on cost and just securing their own supply. Historically, Wolfspeed was dominant in SiC materials, like over 60% market share at one point.
That dominance isn't guaranteed anymore, is it? Competition is heating up.
Oh, absolutely. That historical dominance is being challenged. While they were pioneers, especially in the materials, the market is getting crowded.
Who's entering the space?
You're seeing players emerge, particularly from China. Companies like Tank Blue are getting into SiC materials. More competition inevitably means pressure on prices, pressure on market share. It's not the wide open field it used to be.
Okay, so fantastic technological potential, big strategic bets on manufacturing. But now we have to pivot to the less rosy side, the finances. The risk of bankruptcy is, well, being talked about openly.
It is. And unfortunately, it's not just speculation. The risk is tangible based on their financial performance.
So what are the red flags? Let's start with the bottom line. Losses.
Yeah, substantial net losses. For example, in their second quarter of fiscal 25, the GAAP net loss was $372.2 million. That's a huge number for one quarter. And it wasn't a one-off.
Over $370 million lost in 3 months.
Wow.
And it's not just the net loss, it's the gross margin too.
That's almost more worrying in a way. The GAAP gross margin that same quarter was negative 20.6%.
Negative. So they spent more just making the products than they earned selling them, before even paying for R&D, sales, admin.
Precisely. The cost of goods sold exceeded their revenue. You simply cannot run a business like that indefinitely. It's fundamentally unsustainable.
Okay, huge operating losses. Then there's the debt. How bad is it?
It's significant. As of the end of December 2024, they reported $3.38 billion in long-term debt.
Billion. With a B.
With a B, and a large chunk of that is in convertible notes.
Right, convertible notes, these are loans that can turn into stock, yeah.
Under certain conditions, yes. Which can dilute existing shareholders, but the more immediate problem is just paying them back or refinancing them when they come due.
And there's a specific batch causing concern, the ones due in 2026.
That's the near-term crunch point. There's a $575 million tranche of convertible notes due in 2026.
Okay.
And the market is showing serious doubt. Back in April 2025, those notes were reportedly trading around 60 cents on the dollar.
Oof. So investors buying that debt only expected to get back 60% of their money. That signals real worry about repayment.
It absolutely does. And remember that failed debt swap attempt back in March. They tried to exchange some debt, it fell through, and the stock took a major hit. That just highlighted the difficulties they face in managing this debt load.
So losing money hand over fist, negative core profitability, billions in debt they're struggling to manage. Where's the cash coming from to keep the lights on?
Well, that's the other major concern, cash consumption, free cash flow.
How bad is the burn rate?
In that same Q2 fiscal 25, the free cash flow outflow was $598.1 million.
Nearly $600 million burned through in one quarter.
Yes. They are consuming cash at an alarming rate to fund operations and their big capital expenditure projects, like building those fabs.
Which makes them incredibly dependent on getting more money from somewhere else, right? External capital.
Completely dependent. And the big hope, the big potential lifeline everyone's watching, is funding from the U.S. CGPS and Science Act.
How much are we talking about there?
They could potentially receive up to $750 million. That would be huge for them.
But it's not a done deal.
Not at all. It hasn't been finalized, and critically, this kind of government funding usually comes with strings attached. Reports suggest conditions include things like, guess what, restructuring their debt.
So even getting the money requires tackling the debt problem.
Exactly, and any delay, or if the funding falls through, or if the conditions are too tough, it dramatically increases the bankruptcy risk.
So the CGPS Act money is necessary, but maybe not sufficient on its own. There's still execution risk.
Massive execution risk. Getting cash is one thing. Turning the ship around operationally is another entirely.
What do they need to do?
They absolutely have to get that 200-millimeter production ramped up successfully at Mohawk Valley. That's been slower and more challenging than expected, it seems. They need to improve manufacturing yields and get costs down. That's job number one for the new CEO, Robert Furl.
Okay, fix manufacturing. What else?
They need their latest technology, the Gen 4 SiC MOSFETs, to really gain traction in the market. Customers need to adopt it widely for revenue to grow and, hopefully, for those margins to improve.
So it's a race against time, really. Fix the factory, sell the new tech before the cash runs out or the debt comes due.
That sums it up pretty well. It's a high-wire act.
Now, amidst all this gloom, are there any potential positives, catalysts that could help them pull through?
There are a few glimmers of hope, yes. Potential catalysts, as you say.
Okay, like what?
Well, obviously, finalizing and actually receiving that CHIPS Act funding would be number one. That provides breathing room. They also recently received some tax refunds, $192.1 million in March 2025 under Section 48D of the tax code related to their investments. And they expect more, potentially around $1 billion total over time. That's real cash coming in.
Okay, see that GPS funding, tax refunds. What else?
Just pure operational improvement. If the new CEO can genuinely get the 200-millimeter ramp sorted out, improve yields, cut costs, that would change the narrative.
Better execution.
Yes. And strong market uptake of that Gen 4 tech we mentioned. If customers love it and buy a lot of it, that helps the top and bottom line.
Anything else? Maybe something related to the stock itself.
There is the fact that the stock has very high short interest. A lot of investors are betting against it.
Ah, the short squeeze potential?
Exactly. If some significant positive news does come out, like confirmed CHPS funding or sudden improvement in margins, all those short sellers might rush to buy back shares to cover their positions, which could cause a rapid, sharp increase in the stock price. It's speculative, but it's a factor.
So potential lifelines exist, but none of them are guaranteed, and they still need to fix the core operational and financial problems.
Precisely. The path forward, even with potential help, is loaded with risk. It depends heavily on things going right externally, like the funding, and on management executing flawlessly internally.
Okay, so let's try and wrap this up for you. Wolfspeed, clearly a leader, or at least a pioneer, in silicon carbide tech, which genuinely have the potential to revolutionize power electronics in EVs, AI, renewables, and more.
The tech promise is real, yes.
They've made huge necessary bets on scaling up manufacturing with 200-millimeter wafers and new automated fabs. Strategic, but expensive.
Very expensive.
And it's a massive but. The company is currently in serious financial difficulty. We're talking major losses, fundamentally unprofitable production right now, a huge debt load with looming repayment deadlines, and they're burning through cash incredibly quickly.
The financial picture is deeply concerning.
So the risk of bankruptcy isn't just chatter. It's a very real possibility hanging over them. Their survival likely hinges on getting that CTPS Act funding, maybe those tax refunds helping, successfully refinancing or restructuring debt, and crucially, a major improvement in actually making and selling their products profitably.
That covers it. The potential upside from the technology is matched by the significant downside risk from the financials and execution challenges. It's a high-stakes situation.
Thank you for walking us through all that complexity. It's a lot to unpack.
It certainly is.
If you found this deep dive helpful in understanding the Wolfspeed situation, please do subscribe to the deep dive so you don't miss our future explorations.
And maybe give this discussion a like if it clarified things for you.
Absolutely. And hit that notification bell so you know when we drop our next analysis. We really appreciate you tuning in.
And maybe something for you to think about as we sign off. Looking beyond just Wolfspeed, what underlying factors, be it technology breakthroughs, supply chain shifts, or maybe geopolitical changes, do you think will ultimately shape who wins and who loses in the broader Silicon Carbide race over the next decade?